Now we continue our special series, Wall Street's Hottest Funds. T. Rowe Price Health Sciences Fund has outperformed 98% of its peers over the past 5 years. Kris Jenner runs the $3.3 billion fund, and he joins us now from his office in Baltimore. Mr. Jenner, welcome to Bottom Line. Thanks so much for coming on today.
Thanks for the interest.
Mr. Jenner, healthcare, it's one of the winning sectors this year. Why?
Well, it came into the year 2009 and 2010 were underperforming, so I think institutional investors were underweight. Two other things that have happened. I think there's an expectation for a modest improvement in healthcare utilization. I don't think we have it quite yet, but I think it will come. And then I think the third thing is kind of what you're referencing in terms of a slower growth than expected, and S&P earnings in the back half of this year are probably going to face difficult comparisons.
Yeah.
And so healthcare has acted defensively and reliably.
You say healthcare underperformed in 2009 and 2010. To what do you attribute that?
Well, I think it's the mirror image of why it's outperforming now. Those were the periods where there was a very meaningful snapback, where the market started to rebound very aggressively, after the 2008 financial crisis. And so you had a very significant snapback. A lot of stocks were priced for dead, and healthcare kind of held its own in 2008. And it was sold to buy stocks that were more leveraged to that snapback. And in addition, we had the concerns about healthcare reform. Those two factors, I think, in combination, held healthcare back in those 2 years.
Well, those concerns about healthcare reform, how have they affected your fund, if at all?
I think for the first time in many, many years, healthcare policy and what is happening in Washington is very much on our mind. I think we are kind of in a slow year in 2011. A lot of rulemaking, of implementation in anticipation of the full effect of the bill going into law in 2014. So I think we're kind of in a lull before the storm. I think in 2011 we have a little bit of a reprieve. In 2010, though, it was very much on investors' minds.
Mr. Jenner, is that something? There are vagaries in the markets, there are vagaries in life, but at some point, how do you decide which factors to use to price in and which to just avoid, at least for now?
Well, I think that we have had in our strategy one of an emphasis in innovation, strong management, revenue and earnings growth. And I think if you keep your eye on those elements, I think you're going to kind of weather a lot of storms. And yes, you have to be aware of policy changes. Healthcare reform is an excellent example of that. But I think if you simply focus on strong companies with strong managements that will grow their earnings reliably, you will do well over time. That's really been our focus, and our results bear that out.
Mr. Jenner, do you also look towards Washington and this upcoming battle over the debt ceiling? Does that affect you at all?
I think it affects everybody. Healthcare is the most significant, most rapidly growing long-term liability. We're in a budget-constrained world. Certainly, those discussions will have an impact on Medicare and Medicaid. You can't be oblivious to them, but again, keep your eye on the fundamentals with an understanding of how these policies can affect the fundamentals.
Mr. Jenner, before we get to some picks, I think it's interesting that you point that out. In the economic environment that we've been in for the last 2.5, perhaps even 3 years, is it possible that you see some folks, they take their eye off the prize because they lose sight of the fundamentals and perhaps maybe panic just a little bit?
Well, panicking and then human psychology is a normal component, of the market, and that's what provides opportunity. We certainly look for that with our fundamental research, and look for companies that really provide very good bargains from time to time when there is clear controversy in the marketplace. But the long answer to your specific question is yes, that provides us periodic opportunities.
And speaking of some of the companies, let's start with Stryker Corporation. Why do you like them?
Again, very strong management, a steady, reliable business. It's kind of out of favor in the marketplace, but we think that if orthopedic utilization improves ever so modestly, this stock will do a lot better. It has actually outperformed this year, but we really like it over the 12 to 24 month period because of a 14 to 15% bottom line's growth profile and for a very reasonable valuation.
Well, if it has that double-digit growth profile, why did it fall out of favor?
Well, it fell out of favor because the market doesn't right now share our view of its growth prospects, and more specifically, looking in the rearview mirror, healthcare utilization did fall down in the 2009-2010 period. Stryker was not immune to that, and as I said, it's one of the factors we think that's actually going to be an opportunity going forward. One
of your other picks, Dentsply International. What do you like about this one?
This is one that we're really excited about. We've been a long-term shareholder here, but they just announced a deal that we think will significantly accelerate their bottom line growth. They made an acquisition of a dental implant business, has not closed yet, but when it does, I think over the next 2 to 3 years, you're going to see a nice acceleration in their bottom line. It's not a company that's on a lot of people's radar screen, but that's the way we like it, an opportunity yet to be discovered.
Another diamond in the rough, perhaps, Alexion Pharmaceuticals?
This is a company that really best exemplifies our fund's focus on innovation. It's been a long-term investment for us. Stock has now reached $9 to $10 billion. It's taken a bit of a pause over the past few months, but because of their innovative product, Solaris, that can affect a multitude of ultra-orphan diseases, we think this has a long way to go. So we think that we're in the middle innings of a long-term growth story here.
Mr. Jenner, in our last 30 seconds, if I might ask, I had two economists on earlier today, Diane Swank of Mesirow and Michelle Meyer, Bank of America, and they were giving us their assessment of the next 6 months of the year, the first 6 months coming in to an end today. You have any thoughts on how we might appear financially, economically in the next 6 months?
Well, now you're really talking about something that's outside of my pay grade.
Understood.
But what I will say is one of the reasons that healthcare has actually performed is I think there's a view, while we're not going to grind down to no growth, the level of growth is going to be more moderate than what we thought. And that's an environment that's conducive to healthcare investing.
Kris Jenner, he runs the $3.3 billion T. Rowe Price Health Sciences Fund, joining us from Baltimore. Mr. Jenner, thanks so much. We appreciate your time today.
Thank you.